Inflation is kind of a big deal, and in fact, we're going to see what happens in this coming week because right now we've got so many different central banks are meeting up and they're going to decide whether they want to cool down inflation or whether they want to let it run hot. You came here for the truth, so let me unveil that for you. I'm going to show you what's happening right now today as it relates to the Federal Reserve, and of course, let's not forget about the bank crisis. When they increased interest rates, that presented a problem for banks like SVB or now First Republic. All of this predicated around a cycle that repeats over and over again. And if we simply zoom out, we're going to be able to see this happening right before our very eyes. Let me show you. Fed seen boosting rates even as economic risks build. Now, we knew this was coming, that they would increase rates. If you were here on this channel, you've heard all about that. Quarter point hike and healthy jobs report anticipated. ECB Norway may also raise rates while Brazil stays on hold. You got to see this in the chart I'll show you here. It's important because it's not just one central bank, it's all together, right? This is a whole financial system. Everything's connected. So when increasing interest rates happen in a bunch of different countries around the world, that generally tightens the economy and the lending and all that, okay? You could see between Tuesday, Wednesday, and Thursday, several central banks, Fed, Brazil, ECB, and other countries, Australia and so on, are deciding on their rate increases. Do they want to slow down inflation or let it run hot? We're going to see, and I'll bring you all of the details. You got to subscribe to the channel so I can do that. Now, this was the big article. This was the big one, a debt crunch. Why would you suggest that a debt crunch is coming when the Federal Reserve printed literally trillions of dollars? Well, here, signs are mounting that a debt crunch is looming. Funding crunch complicates the Fed's decision making. Lending is shrinking and the money supply is contracting. All of that here. I'll show you several charts, but understand that this is all about what we're seeing with the bank crisis. This is so huge because most people, they don't know. They don't know how to dissect the information, but that's why you're here. Let me show you several charts, in fact. You could look at it. Bank credit spreads underperform amid the turmoil. You could see over the last while, particularly, I would notice in the biggest problems, by the way, with the regional banks, but that's besides the point. Money supply is shrinking at the fastest pace since at least 1960. I mean, crazy. Provisions are piling up. So we got all the major central banks doing a couple things. They're writing off bad debt and they're setting aside additional reserves. Why? They're worried. They're concerned that there's going to be more failures, that as increasing rates takes place, people can't pay back. Whoever's borrowing, even on the commercial side, they can't pay back either. Even Brookfield defaulted on one of their loans. Regional and local banks are big lenders to retail and offices, and that's really something that was not understood prior to the whole SVB scenario. We got to realize this. Regional banks, yeah, they're smaller, but they represent a large percentage of the total lending. And so you got a problem, big problem coming in that is not resolved at all. You can bail out these companies, but you can't resolve it just like this. Higher defaults. Look, spreads signal higher default rate in the United States, still low compared to what we saw during the financial crisis, but it is elevated here at this time. Okay, bosses are talking about credit like they did at the start of 2020. We got to think about this and what it ultimately means because we're still early in the game, I think, but it depends on the Federal Reserve's actions. Really important to highlight that, and we will see. We really don't know. Investors doubt if Colombia's rate hike can stem the meltdown. So this is just an example. No, Colombia is not the United States, but the patterns can be the same. It's that when you have inflation running hot, when you are moving through the cycle, you have to take decisive action, and that is managing this properly, increasing interest rates beyond what is necessary so that you can force it down. And as things are coming down, then you can slowly act. You don't have to go wild on the way up, wild on the way down. You create this boom bust cycle, unless, of course, that you were trying to do that on purpose. I'll leave that to you. France rating cut to AA minus from AA by Fitch on deficits and debt. We've seen some of this happen before, but it's interesting. These rating agencies are important because, for instance, if a fund needs to invest in only AA and higher, let's say, okay, that's all we do. This fund, we only do AA and higher. Well, now they just got cut. So they got to sell that. And that's the way this works. Okay, so that in that sense, it's important. Not in the fact that, nobody really cares about that. I mean, come on, the subprime garbage rated AAA. Well, you know how it goes. I want to also talk about what's happening with the banking crisis because this directly connects in. FDIC asks banks for final First Republic bids due on Sunday. By the time you're watching this information has already been released. And so the idea here would be that you would have a bank, JP Morgan, coming in. Okay. I really think that this is a problem because you're consolidating power and control. You got JP Morgan, PNC. They're talking about this. US Bank Corp, Bank of America. They're going to put bids in and they want those assets. Okay, so what happens during any sort of situation like this, mergers and acquisitions? If you have never worked for one of these financial companies, it's pretty simple. It's what you expect. These companies essentially slash as many jobs as possible when it happens. They go in, they send their team in, and they say, okay, where do we have a lot of redundancy? And so they say, okay, back office. We don't need those people anymore. You're gone. They might outsource a team to the Philippines or something. Maybe it's the tech department. They could outsource that, or simply just say our teams will take that over. You might take 1 or 2 people per department so that they can sort of train those existing people. And that's it. They get rid of a lot of individuals. They merge everything together. Over the next while, they start to, sort of remove that old bank's name from all of their papers and all of, all the statements that they provide and their website and all of their fund names and everything else. They make a transition and eventually it's all them. That's what happens. That's what it goes. And that's what we're seeing right now here today. U.S. auto sale chains closes all locations, including in Athens. Another company is hurting because of where we are in the cycle. As expected, there's nothing that has happened so far that was unexpected. If you were watching this channel, you read my books back in the day, you knew this. It's not a surprise. Households are cash stuffing to cope with cost of living jump. What this article is discussing is that people are basically taking a bunch of envelopes and they're putting the cash in to sort of budget in that manner. And some people do this, some people find success with it. Essentially just trying to intentionally create friction. So they're saying, well, if I got to go into the envelope, I'm seeing it, I'm using cash, I'm not using my tap because there's less friction there. I have talked about this before, but I think the best way to do this is not even to do that, but every time you have to make a purchase, you have to write it down. If it's 1 penny, not that anything costs a penny today, but if it's 1 penny, you got to write down what it is and exactly how much it costs. Pen and paper. That way, just the act of you having to take that out, having to write it down, you'll be less likely to purchase it. It's a simple thing, but it actually works wonders. Digital wallets become a buy now, pay later battleground. They talk about Amazon with Affirm, who is Affirm being a huge favorite of your local friendly YouTubers out there. I'm pretty sure the stock collapsed at one point. Anyway, hope nobody bought in at the top. They also refer to Citi Flex Pay. They're talking about different aspects here of this buy now, pay later kind of thing that has taken hold. In my opinion, I mean, this is crazy. This is crazy to utilize that unless it's some sort of very, very this emergency. I need the money now. I need the money immediately. If there's no other solution, okay, let's just get it over with and done. But my goodness, it's predatory lending. The bank's first special purpose credit program will allow for adjusted credit guidelines, which are expected to enable more business owners to qualify for a loan. Like, this is basically talking about the fact that they're loosening lending restrictions for some in order to get people to loan more. And why would they do that? Well, of course, this is what they always are actively doing. They're trying to loan to more people and get around. The banks don't care if some people can't pay their bills. They can write that off. If a lot of people can't pay their bills, then it's a problem. But if it's, a certain percentage, they don't care. They're all good with that. I want to do a whole video about this. MasterCard braces for the Fed's real-time payment network. Look for a video on this, but essentially saying that MasterCard has to deal with the FedNow system that is in place now, and as we see it developing over this year. I think it will be very interesting to see what happens and how many businesses started using the FedNow system. Look forward to that video in the coming days. I'll see you then. Take care.